I want to talk to you about this man that you have here. Many of you don't know this guy. In his field, you think he's here, and there's just a little bit above. He's in the second tier. He is up right at the top. Dan Fuss, biography is in your hand. He runs one of the best performing bond funds in the country for Loomis Sayles. You want to know his record? He's in the top quartile of performance for the past 15 years, which for him is only a start with what he's been doing. I'm using one of his jokes. It's or type jokes. 10-year, 5-year, and 1 year, all of them in the top quartile. By the way, that's one thing you got to look at when you get performance. If you have performance over a 10-year period, and the first year, the last year, you've been up 90%, it could mean that you were underperformed. You did terribly for 9 years, and 1 year dragged your performance to the pinnacle. Watch that. Watch out. We watch it out for you. He is one of the most distinguished persons in the bond industry, having been named to the Fixed Income Hall of Fame, received a Lifetime Achievement Award in this area, and obviously is a font of knowledge. But I like his low-key, made me laugh when I was just talking to him for 2 minutes. The low-key method of presentation, sometimes with a subtle sense of humor, makes me think of him as the Warren Buffett of bonds. And he is thought by some as the Warren Buffett of bonds. And in addition, he's made lots of money for you and your portfolios with us. So without any more, I'd like to introduce Dan Fuss.
Well, they have me wearing a wire. They didn't say why. So, all right, can you hear me in the back of the room? I'm sorry. As to the introduction, it was very nice. Thank you, Lou. It was very nice. Another and easier way to say it would be that he's one of the oldest people doing what he does who can still walk and talk simultaneously. So let's talk. And I'll wander just a little bit. Just want to be sure you don't get ringing in your ears. I'm going to move rather fast. I'm being timed, which is good. That way I won't wander off. But I do have to tell you, being in this building, in this room tonight, giving a talk is special for me because it's not a conflict of interest, but I have a special interest. One of my daughters, number 3, Diana, is a professor at Princeton. So I can say to her now, yes, well, of course, Dan, I have spoken at Princeton. All right, now let's roll. And let's put things in compartments so that we can briefly look at them and the things that are affecting the market tonight, tomorrow, and probably for quite a while. In order of importance, the first and by far the most important thing that affects us, all of us, no matter if we have a portfolio or not, is peace or lack thereof. And the trend, are things getting better or worse, or at least negative? The next one is people, which is a longer term thing and normally relates to the aging demographics, but also these days, the movement of people in the world. We won't spend too much time on that. The next is politics. And politics has 2 divisions, our own in this country and things elsewhere. And then last in the primary area, most of the time, is prosperity, or again, lack thereof. And in essence, the economy and the markets. And there's a special thing now for the last couple of years that we have to carefully consider, and that is very important in all of the markets, and that's the changing role of the major central banks, including our own, the Fed. So let's start. All right, peace or lack thereof. For most of the early part, the mid part, of my life, peace or lack thereof was a very active thing. But once the wall came down, then for quite a while, the drift was towards a little bit less worry about peace, less the risk of people shooting each other in the aggregate, and more towards lack thereof. And that was good, and that's changed, unfortunately. And we're now in an environment that's very difficult to express analytically, but you can feel it, and you can see it, in that the trend is slightly the other way. Now, if you happen to be in Syria right now, you'd say, what do you mean, slightly? It's the whole show. And that's true across the Middle East. There's also a pocket of possible trouble, although I do think it's getting a little bit better in the South China Sea, but it's an area you've got to watch. And then near at hand, probably this weekend, you have the situation in North Korea. So you have things to worry about. Now, the North Korea type thing is, I don't know how you deal with that investment-wise. I really don't. It's an event that would be awful or the end of a worry, and we don't know the outcome. And it's not in the markets, it seems to me, either way. The movement of people from the area of the Middle East and the distress that's there is unfortunately probably going to be with us a long time, and it is definitely affecting other parts of the world. As well as the tragedy there, it's having quite an influence in the areas just north of it. And for that matter, a little bit to the east of it. And it's starting to spread, and it's becoming something that absorbs effort in people and financials. So it's a growing worry. And it's severe because people, to move to that area, are being displaced and moved. Now, most of us wound up with we're here because our ancestors, or in a number of cases, we left someplace else to come to a better place. I know that's my heritage. And I think most of the people here, and we're in the better place right now. But there are people in the world that are not in the better place, and they want to be, and they'll do their best to be here. And that's a factor in investing. Politics, I have learned as I've gone around the country and overseas, this is a topic you don't want to get caught in a long discussion on. It's perfectly fine in Boston. It's even temporarily more important than the Red Sox and the Yankees. Not tonight, however. But by and large, it can be a rational discussion of how it affects markets. Do not try that in Kansas. I've learned that. That's firsthand experience. It's something that you have to brush by, which is unfortunate because it is clearly impacting not so much the day-to-day of the investment markets themselves as the surroundings for the investment markets, including our central bank and several others. And this is a real touchy topic, and we'll come back to that under the central banks. As far as international politics, they're being heavily influenced by our own. And I've been in 4 countries in Asia and 2 in Europe having these discussions. And to go with the most recent first, I was just about 3 weeks ago, I was in Frankfurt and Madrid, both in one trip. Beautiful weather in both cases, fine dining in both cases. I think I'm up about 5 pounds. I was very anxious to speak with the people I was visiting with about European politics right now. And they were very relaxed, very relaxed. Now, in fairness, the elections, 1, 2, 3 of them had gone by, and they were breaking the way the business community had hoped they would. And the regional elections in Germany were breaking the way people wanted them to go. The only one that didn't was in Spain, where it was for the Socialist Party leadership. That broke the wrong way for the investment markets, and in the view of business friends of mine. So, but the trend was slightly back, and pleasant news, somewhat unexpected, particularly in France, where it was a shift towards the middle, which is about the best place for the investment markets. And we could continue on that, but that's the overview. Now, when you get to the prosperity part of this, then you have to stop, divide things up, and say, well, how are things going economically in the world with this particular setting that we have? And that there, excuse me, the setting's actually reasonably good. And I've learned from people I know that visit there, and from my own visits, that Japan is a prime example of that. I keep hearing the stories, well, look at the numbers. They'll say, Dan, look at the numbers. Geez, things are really tough. Well, I've been in Tokyo maybe 20 times over the last 15, well, more than that, over the last 15 years. Things are not tough in Tokyo. I go look at the numbers, and I visit with our clients. We have a large client base there. And business is good. Unemployment is the lowest of any major nation in the world. And people are retiring on Friday. They have a nice, brief party. And Monday, they're back at the same job as consultants, making a touch more money once you consider their retirement pay, plus their consultants' pay. And they have benefits. And you say, oh, this sounds pretty good. I enjoy working. I'm somewhat older than the normal retirement age. I ought to move to Japan. But Loomis says, no, stay here. We'll treat you nice. And they're short of people. And there's a little bit on the participation rate with younger people, but it's not even measurable, not like here. And you say, well, what's going on? Well, first place, it's an aging population. There are actually less people, according to the official count, who are citizens. There are guest workers, but that number seems to have stabilized. The modern techniques and technology is certainly helping out a lot, but it's a highly mature society that on the surface and below the surface is very peaceful, somewhat free of stress. That's starting to change. There's a lot of articles now on the return of the militarists and this type of thinking for obvious reasons on the geopolitical side. That's Japan. So it's deceiving. And if you start to measure economic output, GNP per capita, things like that, and if you measure GNP per working age population, you say, oh, hey, things are humming, and they've got low interest rates. The long bond in Tokyo yen pay right now is about 66 basis points, 5/8 of 1%. They have a huge debt, and they buy it themselves through the central bank, and sort of hums along. In Europe, it's a mixed bag, but in general, in Central and Northern Europe, pretty good. And I'm amazed by the numbers coming out of the UK right now. I thought for sure when the Brexit news broke, I thought, oh boy, we've got, Loomis has approximately 20 people in London, and I thought, well, things are humming for the moment. I'm afraid that's not going to be true going forward, but we'll see. On the continent, it's good. It's quite good. And in the weakest of the major countries, Spain, they don't worry too much because the educated young people go to Germany to work. And I was visiting with one guy, his 3 kids and their families are there, and since the grandchildren are there, his wife moved there and left him to send the money. He, by the way, is having a wonderful time. So in the south and on the western perimeter, not so good. The eastern perimeter of Europe is surprisingly strong. And that I find difficult. I haven't been there myself. I'm getting it secondhand. But some of the start of the shift from Central England on manufacturing, essentially auto parts distribution, the supply chain is going over to the eastern side of Europe because there are skilled people looking for work. And so that's where it's headed. How much that'll amount to, I really don't know. Politics get in there. Now let's get to the central banks, and then we're going to backtrack. I had the enormous good fortune to spend 1 year of my life every Monday for an hour or two, and once or twice a month for half a day or so, being tutored by William McChesney Martin the year after he retired as chair of the Federal Reserve. And he was the factor that the reason I wound up in Boston, because I was here in New York and talking with one of the members of the corporation at Yale. Sorry, Diana, didn't mean that. And he said, I'd like you to meet Mr. Martin. Now, to me, Mr. Martin was one step above God. I mean, oh my God. And so I did. And at the end of that conversation, I had been hired to manage the Yale University endowment. And I thought something happened here. Now, in those days, it was $900 million. That was a lot of money then. At any rate, net, the things he taught me about the central bank are still valid today, but the circumstances have changed. Some things have changed. Some things are the same with our central bank. The mandate has been amended severely only once since 1971, which is when I was running that. It's a domestic mandate. It was put together by a number of people, including Bill Martin's father, as a way to get rid of the ups and downs of the banking system that got rather severe. We did not have a central bank from like 30-something. Andrew Jackson, whenever he was there, he got rid of it. So we'd have the periodic banking panics as money flows went across the country. And the Fed was formed to dampen that. It was also a series of magnificent political compromises when it was put together. It was a balance of power between the federal government and the state governments, or the state regions. And the most extreme example of that within it is, why do you have a Federal Reserve branch bank in both St. Louis and Kansas City? I asked Mr. Martin, he said, politics. Pure and simple. It was one of the arrangements that were made, just as Chicago would have a branch of it in Detroit rather than another separate one. Politics, probably tied into the White Sox and the Tigers, I don't know. Our bank has evolved from making sure the banking system runs and fighting inflation, or controlling it, to use the language, to adding on to that a couple decades ago, promoting employment. And that's about it, with a couple small twists. And it reports to Congress, not to the executive. It has the role of a federal agency, but it's not in the legal position of a federal agency. The executive branch, the president, appoints governors to the Reserve Board in Washington. They've got half the votes. The other half is with the regional banks, the president of one of whom is a constant voter, the president of the Bank of New York. The others are rotating between the other regional banks. They all get together. They're going to do this next Wednesday, Tuesday and Wednesday, down in Washington. They, by the way, have an outstanding chef. So they're all anxious to be there. And they're going to discuss what they will do. And this gets a lot of press these days, a lot of conversation. And It's gone from being very unpredictable back in the 60s to very predictable these days most of the time. At least they try to tell you which way they're going. So most of us, me included, expect next week they're going to probably bump rates up 0.25%, because that's what they've been saying, because that's what their mandate indicates. Now, here's where it gets tricky. The mandate is a domestic mandate. It says it's in the interest of the citizens of the United States. It's drawn for that. When it was drawn, very, very appropriate. And the central bank is sitting down and they're looking at a series of economic numbers widely reported regarding inflation and employment, essentially, and very few other things. And they're saying, oh, we have unusually low rates. We should be worried about controlling inflation, but we want inflation. Here I have some disagreements with them. We want to have inflation at a certain level. Now, with those of you with long memories that go back from the mid-1960s, this rings a bell. It's called the alarm bell because that was the discussion in those days. But be that as it may, the numbers would indicate this. And they say, within our mandate now, we're going to have a rising rate environment. And I was over at the Fed, and Rosengren gave a speech where you always have to bring in the press, and he said, this is what we're going to do, and this is why data dependent. That's a real, I can't get away with that with Rosemary. When I say data dependent, I'll be back in Boston. She said, no, you better tell me when you'll be home. But that's not entirely what they're concerned with. I'll give only one example in the interest of time. Think back to the first week of December in 2013. Roughly December 2nd or so, somewhere in there. There was a meeting in Tokyo of the Association of Southeast Asian Nations, which are most but not all. Japan's not a member. China's not a member. South Korea's not a member. Taiwan's not a member. The others are. They get together and they talk about things and how things might be going. Second day, the Bank of Japan, the Central Bank of Japan, came out and made an announcement. And they said, and this is not unusual for a bank, but they sure made it unusual. They said, today we have set up bilateral, one by one, currency swap lines with each member of ASEAN. So in the event that any one of these members has a sudden outflow of funds for whatever reason, thinking back to the circumstances of the late 1990s, all they have to do is call the Bank of Japan. We'll send them all the dollars they need. We'll send them all the euros they need. We'll send them all the sterling they need. We'll send them all the Swiss francs they need. And by the way, any amount of yen that they need. We can do that because we have, and this was an incorrect statement, we have an unlimited currency swap line with the other four major central banks. Now that's technically incorrect, but practically the case. Well, Thailand at that time was going through their upset. People shot in the street. I was actually supposed to be in Bangkok, and the central bank said, don't come, we're taking the week off to honor the king's birthday instead of a day off. And from that day on, the Thai baht locked right to the US dollar, just like it was painted on top of the US dollar for about 14 and a half months until the new Thai government, the military, took over, said, listen, set us free, at least to a degree, because we want to move with the other currencies in Southeast Asia. Now you say, well, okay, so what's the big deal? What's the big deal? The central banks are working together. Where does it say that in the Federal Reserve Act? Doesn't. It's a factor. It's an important factor. 2 years ago, in the minutes of the meeting, there was a single line Now, it said the committee also considered the international situation. The following meeting, or 2 meetings after, there was more detail where they discussed the situation in the Middle East and in Eastern Europe, and went into no detail, and it wasn't really covered in the speeches. Now, what's the big deal? The big deal is, I think the most important thing that the U.S. bond market is dealing with, and by implication, by the way, on the equity side too, because equities are influenced by the level and direction of interest rates. I think the biggest conundrum right now, and for those of you who pray, I think the target of your prayers ought to be the central banks in order of priority. No, the toughest one is the European Central Bank, and then our own. And those two in particular, and to a lesser degree Japan, because they're caught in a problem. And I personally don't think, unfortunately got quoted in the press on this in Frankfurt, I don't think there's any way out for the European Central Bank within reason. And they're the guardians of the currency. But it's politically too complicated right now, in my opinion, and boy, do I hope I'm wrong. I think they are trapped. Our own central bank, that's not the case. There are many ways out, some of them not very palatable. The easiest one is the one they are professing, and which will drive the direction of interest rates and the outlook for the markets. The one they're professing right now is to say, well, look, in a reasonable setting, here's what we would anticipate. And Eric Rosengren, in his speech with a couple hundred people there, and again on a small table over lunch, said, data dependent, we're going to raise rates, skip a meeting, raise rates, skip a meeting, but maybe we'll substitute the start of shrinking the Federal Reserve's balance sheet, which has grown by our standards to a very large level. In other words, here comes a gradual rise. And data dependent, we will continue that. Okay, that's good. It'll be much better for the smaller banks. The Eastern Savings Bank, Mutual in Boston, will be able to make loans again because they can get deposits again. That'll be a good thing. Bank America doesn't, in fact, apologies to anyone from Bank America here, they don't really tend to the Wellesley hardware store. They need the Wellesley Cooperative to lend them money on their inventory. So this is hurting. The number of smaller banks is declining, and the Fed's own advisory council has been unanimous for approaching 3 years that you got to get the short interest rates higher. Okay. So in general, that would be good, and they're very, very sensitive. They won't try not to harm the economy in the process. If inflation starts to get too high, they'll try to slow it down. It's a wonderful theory. Will it work in practice? We'll see. But the issue is not what's in their mandate. The issue is what else is happening in the world. The issue is, when is the Bank of Japan going to have to all of a sudden hurry with some currency to others? The issue is the feedback they're getting from their contemporaries, that I'm getting from our clients in Europe, and particularly in Asia, even from Japan, of all places. They're saying, Dan, what's happening with the U.S. government? Is your legislature ever able to come together for anything? They are, what's the polite way to say it? They're not happy with last fall's election. And it's even in Japan Times. I try to read Japan Times every night because I have the next day's news, because the next day has arrived in Japan. It makes me feel good. And I don't have to report to the SEC on it. Even there. And so people have asked me this week, they said, well, Dan, this was yesterday, a group of investment people, they say, you know, I can't reconcile. In fact, it was last night, actually, on Bloomberg TV. They said, Dan, look, interest rates have gone down this year on treasuries rather than up. And the Fed's saying they're going to go up and rates are going down. So the Fed's not going to act. And I said, no, I think the Fed's going to act. And by the way, the dollar's weakened all year, even against the Philippine peso. They say, I say, well, interest rates are lower. There's less interest rate incentive. They say, well, that can't be the whole thing, and it's not. Because I'm getting questions from serious people. This is not some of the very friendly people at the door at the Imperial Hotel. They always say 2 words of English to you, and I don't know their language. This is coming from CFOs of major corporations. This is coming from, in one case, the chairman of one of the largest. And he said, Dan, what is happening? And I say, I wish I knew. I really wish I knew. Most of the countries in the world where you have a political problem, what's happened is the center left is parting from the far left. The center right is parting from the far right. And this is good news in a place like France because the center left and the center right are coming together to form the center. And the political process is getting easier. And if France had its own central bank, they'd be having a much easier time. And people are happy, and markets reflect that. It doesn't relieve the problem for the overall European central bank. But in our country, this is not happening right now. And it's got other people worried, and they're starting fundamentally to move a little bit of money out of the currency. And the currency support is weakening despite the fact that you have large institutional money on an arbitrage basis coming into the US dollar and arbitraging back to the yen, depending on the level of short-term rates here. So I'm going to leave you with a question. My question is, when will this stop? The answer is, I don't know. But as it eases, as we get through this period, then I think what will join in the rest of the world is a move more towards the center, which leads to better government, better financials, and more time for me to go to the Yankees-Red Sox game. So thank you very much for listening. Okay? Thank you. Thank you.
I think you were gingerly getting at you're concerned about how long Trump is going to last.
That's part of it, Lou.
Yeah.
That's part of it. It's more than that. The question is this all about, to be fair to say, is it all about Trump? True confessions, I was not happy with the election outcome. I was very happy the time before that with our Republican governor of Massachusetts, who's the most popular governor with the Democrats that we've had. In other words, a centrist. They are upset with Trump. They were gentle in how they said it, although in March of last year, there was a headline of high caps on the Asian edition of Barron's. All capital letters, big, Trump, not fit to govern. I about fell out of my chair when I saw that. In Japan, I'm reading this. And he was not treated well by the Japanese press until after the election, at which point everything was fine, and Abe was the first international leader to come to the U.S. to congratulate Trump. Adaptable. The problem runs deeper than that. The problem certainly has been aggravated at no end by the public statements. And some of us, me included, were hopeful that some of the people gathered around him at the cabinet level might, be a protective situation and help. So far, that hasn't helped with the verbiage. But when you look at our own government, you say, well, what's going to come through the legislature this year? Paul Ryan had a very clear agenda. It's not happening. It's not happening. And I don't know him. I know a number of people. I'm from that area who know him and say he's a wonderful guy. A little pig-headed, but a wonderful guy. He's not going to get any part of his agenda through.
So might I ask you, what do you like right now in the bond market and in the stock market?
Okay, what I'm doing in the bond market with all this, and then I'll tell you about stocks. The stocks are for those who must, Lou. I learned that from you some years ago. In the bond market, what do you do? Well, in terms of nominal returns, particularly in munis, but also in taxables, you have an environment where this is the environment I grew up in. My first 23 years, interest rates always went up. It was wonderful. People thought I was smart. Why? Because you're always reinvesting at higher rates. And so various straightforward fixed income techniques. You can add value by riding the yield curve. Munis have a special advantage in that they have a more permanent positive. Long rates are just about always higher than intermediate short rates. So that's very good. Does it keep up with inflation? Well, if inflation gets out of hand, no. But if it doesn't, this is a nice thing to do. And it really works. You have to be a little more careful on credit because it gets more expensive to roll over your debt and to refinance. It also gets better for a lot of the credits because it gets harder for their competition. If they have a better market share in a growing area, they have an increasing advantage. This is where the growth stocks came from. And so that's good. On the stock side, this is tougher. And you have a new ingredient these days with the ETFs and the index funds. My own personal view is I would treat this with a combination of value and growth, known as growth at a reasonable price, otherwise known as GARP. Not GLOP, but GARP. The GLOP is glow. What the no. Whatever. There's GLOP and there's GARP. In other words, focus on value where the direction of the company has a future, not value where it's a declining company, because that's not good for the shareholder in the last analysis. So if you can find low discounted present value. I happen to manage money in Omaha, Nebraska, part of which is supported by apparently he must have a lot of money, unknown person who definitely looks at the results. And I've been doing that for 30 years, so I assume he's happy, whoever this unknown person is. And if you can do that on the stock side, will that keep pace with bonds? Yeah. Will it do better than bonds? Well, what's your tax situation? Becomes the question. Probably, if it's taxable income. If you have a high incremental tax rate, it's a little hard to walk away from munis in this environment, particularly if you have a double tax advantage like you do in New York. I like munis actively managed. I do not like them. I do not like them on an index basis. That's the one part of the market where I say I will not stand an index. Because what you want to do is you want to roll down the muni curve, right? You can add a couple % per annum. Now, full disclosure, we don't manage munis. I'm thinking of going back to it.
Interesting, interesting.
And but that's for a taxable investor, that's really difficult to beat with stocks or bonds. With the lower incremental tax rate or non-tax, then it doesn't match with either the stock or bond approaches.
Okay, why don't we open up for some questions?
Any brave people?
How does the desperate refugee situation, people coming to Europe from Middle East and from Africa, affect the economy there?
Boy, okay, we have started with the $64 question. I had two very interesting conversations in Frankfurt on that. It's been an issue with the popularity polls for Angela Merkel. And she's had to back up a bit on her view, which I think was a very generous, welcoming view to displaced people. And it also was very, very helpful because Germany is short of people in the working age bracket with skill sets. Now, a lot of the people coming didn't have the skill sets that they're short of, but there is a demand for people to work. Unfortunately, what happened in Germany is I'm secondhand from people there. They said, well, Dan, maybe you're going to be a bleeding heart. And I said, well, yeah, I am. And they said, but you have to understand, these were primarily young men that were coming. And I said, young men. My great-grandson's a young man. Well, about to be. In other words, I haven't been a young man for a long time. I've grown wiser. And blending them in is difficult, and it's particularly difficult when you get into some parts of the country or some parts in a couple of the major cities where they're not overly welcome and people are resentful. So it's a political issue. But what are you going to do? What are you going to do?
Okay.
So the $64 question has no answer. To speak of Princeton for a minute, since we're in their club, Princeton has a program right now that my daughter and her husband are trying to help with. And where through Princeton, you bring in refugees after they've been vetted for about 3 years. And you bring in families. And so Diana and her husband want to do this. They have a big house that's now empty except for the two of them down in Princeton, not a bad place to live. And they have sufficient income. They're both at the university. And they would like to bring in a family and help them. They can't get it through. Now, it's a tiny drop to have a family with 3 kids come in. There's a lot more people that would like to. And I don't know the details, but her husband Jim was saying to me, he said, I tell you, Dan, these people have been triple vetted. And by the way, we could have him in a job right away at the university. Why doesn't that work? Much better. The principal problem we have is actually not coming from overseas, it's coming from the South. This is a whole different discussion. Okay.
Okay, next question.
So you left us hanging on the European Central Bank. Do you think that's going to hang itself or what?
No, I think what's happening is right now things are okay. But they have artificially low rates. the base rate in German bunds, which is the equivalent of our U.S. Treasuries for that market, is negative. Now, we run some money in Europe that has to be distributed around the major issuers. So we have to buy German bonds. We have to pay to lend the money. It drives me crazy. You have to get all the way out the curve to have a positive return. Now, you want a positive return and you're going to be in European government debt? Well, okay, you can get a very nice yield on Greek government bonds.
What are they going to do about the easy money policy?
Continue it. How can they wind it down? Because they've gone to the point, I should add some detail here. The European Central Bank doesn't just buy government bonds, they buy corporate bonds. And a yield on Portuguese corporates is about 4%. Maybe very weak triple Bs into the double B range with a poor credit outlook. 4%. What happens if the European Central Bank stops buying corporate bonds? Oh, that's the setting that they're in. And if you looked only at that northern part and didn't get into the Iberian Peninsula, you would say, well, okay, let's stop all this. But if you expand out to a degree to Spain, certainly to Portugal, go to Italy, Greece, what are you going to, the Greek bonds aren't eligible for them. Or up the east side, what's going to happen to the economy? That's the bind they're in. And I don't know Mario Draghi. I've never met him. I've been in the same room. But I think he's got the toughest job of any central banker around. And I just marvel at his ability to stay with it. They've got a very good staff. But they're caught. They're trapped by the political organization. And you don't want to see the European Union get any weaker. You'd like to see it get stronger. And maybe the answer is other countries up north get strong enough that the people start moving more freely. Like the earlier example, the young people from Spain are moving to Germany. And once they're there, married, raising kids, the mother comes over and the father stays home. He's having a good time in Madrid. And that's the setting there. So I think expecting European rates to go up is wishful thinking, and that will be a limit on how far our rates go up to a degree. It'll be a drag on it. Okay.
One more question.
Okay.
So on U.S. Bond market, is your big concern now credit risk or interest rate risk?
Interest rate risk, but interest rate risk adds to the credit risk. If you think of credit risk in the terms of a cycle, like the clock, let's assume there's midnight, that's about the optimum, and then you go to 3 a.m. or p.m., either way, and things are really pretty good, and you get to 4 to 6 in that range, you say, well, this is really good, but it's starting to, it's now not getting any better economically for corporate earnings. And then you go past that, and you get, say, from 6 o'clock to 9 o'clock, which is where we are now. And you say, well, okay, if interest rates rise now, which they normally do, and which we expect to a degree, this is going to get harder on the secondary companies in an industry. Any place where they need to get money to keep growing, or to refinance debt that's outstanding. When you're over in the first half of this thing and you need to refinance, that's all right because you are refinancing at a lower rate. Now you're starting to refinance at a somewhat higher rate. And if you've got too much debt and it matures too soon, you have a huge problem. As you go in, you get past that, you get over around 10 o'clock, then you start to say, well, okay, I can start to pick up some of the pieces here. In other words, you start, what's the old saying? Market growth, market share, market growth, market share, market growth, market share. Is very, very true. Then you get up there and you start to roll over and go through it again. We've been going seesaw right along the bottom from like 5 to 7, 5 to 7. And as I describe it, I start to get a little nauseous. It's seasickness. And that's where you're at. And now we're pushing past 7. So credit risk specifically is becoming more of a problem because interest rates specifically have started up. And thank you all very, very much. You're very kind.
Thank you.
Thank
you very
you.
much. Thanks for a very entertaining and informative session.